Thank you so much, Chris. Thank you so much for inviting me. It's a really wonderful event, and I'm very honored to be part of it. So this paper, this presentation is going to be based on a paper that's joint work with Sergio Correa and Emil Werner. Can you see the slides, or is it? Are they? There they come. There they come. Very good. Sergio's at the Richmond Fed, I'm at the New York Fed, so our disclaimer applies. These are our views, and not those of the Federal Reserve System. So the starting point of this paper is that the objective of banking supervision is to safeguard the health and the stability of the financial system. So the way we think of it is banking regulations is the rules in which the banks, under which the banks can compete in the marketplace, and supervisors are really all about making sure we're compliant with those rules. And we're spending as a society an enormous amount of resources on banking supervision. So the OCC, the FDIC, and the Federal Reserve each alone have thousands of bank examiners. That's not even to count all the state bank regulators. But also banks themselves, of course, spend a lot of real resources in making sure to be compliant with those requirements from examiners. But maybe perhaps because of that, or maybe perhaps surprisingly, banking supervision is an enormously hotly debated topic. And I would say, to simplify things a little bit, there's three reasons how supervision can be hotly debated, or three aspects to which it can be hotly debated. One is that supervisors are often criticized to not rein in risk-taking before bad things happen. So sort of think of the run-up of the GFC and supervision not cracking down on certain types of lending practices. Second type of criticism is that once something bad has happened, supervisors are maybe too slow to react to kind of clean up the mess, to close failing banks. And by that, sort of they contribute to increasing the cost of crises. And on top of that, sort of most recently, we hear again this argument that supervision is really sort of a core constraint on the banking sector's ability to provide credit to the real economy. Now, it's really important to understand to which extent these criticisms are fair and justified, and to which extent they may be sort of a little bit misguided, especially in the light of sort of more recent debates of the current administration thinking about sort of streamlining or consolidating and reforming the regulatory and supervisory landscape. Sort of in the spirit of Andy's comments, research is sort of what we want to sort of guide those kind of efforts, which we all think, if we all agree that there's sort of scope for reform, we kind of want to guide it by evidence. So this is where this paper comes in. We're going to just ask three very simple questions. Okay, question number one is, do supervisors sort of anticipate bank failures before they happen? Are supervisors usually sort of overwhelmed by market forces, as was in the case of the failure of SVB, or do in most failures supervisors really understand long before the failure happened that something is off with an institution? Now, the answer is going to be yes. Supervisors typically understand very well which banks are in trouble and which ones are not. Now, the second question is, if you understand as a supervisor, what bank's in trouble and which one's not, what kind of actions are you undertaking in those relatively more distressed institutions? And then the third question is, what are the causal effects of banking supervision? So what I'm here after is essentially I want to come up with an estimate. If a policymaker came to me and said, what if I make banking supervision stricter or more lenient, what will be the effects on the banking system and maybe the local economy? Okay, so rather than summarizing the results for you in one slide, I'm just going to straight go ahead and answer all those questions one after another. Okay, question number one, do bank supervisors anticipate bank failures? So I'm going to do here for you, I'm going to plot dynamics in sort of about 500 bank failures since 2000s in the 10 years before those failures happened. Okay, so I'm just going to have a sample of these 500 banks. I'm going to look at various ratios constructed out of call reports. Let's look at those first two lines. They're going to show you the evolution of non-performing loans as a share of total loans and loan loss provisions as a share of loans in banks that end up failing. What you see is around 5 years before a bank fails, some non-performing loans start to show up on the asset side of the bank. And as a response to that, the bank starts to provision. Under modern accounting, provisioning is going to affect income, so net income is going to decline. And if you're not recapitalizing, which seems to be the case, equity over assets is going down. So in a failing bank, in the 10 years before it fails, the equity to assets ratio is going to fall by something like 7, 8, 9%, depending on how you exactly construct the sample. At the same time, a bunch of other stuff is going on. Charge-offs are going up, allowances are going up, dividends are going down. Okay. Now, what are supervisors doing at the same time? Now, that's going to be on the right y-axis. You're going to see the average CAMELS rating in those failing banks is going up by quite a bit as those financials start to deteriorate. So your average bank is going to have a CAMELS rating of 1.8 or so. In the 10 years before leading up to failure, that's going to increase by more than 2.5%, which is another way of saying this: right before failure, failing banks tend to have an average CAMELS rating of way above 4.5. Okay, that's just a very simple way of illustrating that supervisors are very well aware of which banks will fail and which ones will not. Now, given that that's the case, at least in the short term, supervisors are very good at anticipating failure. What actions are they taking? I'm going to focus on 4 types of actions. One is scrutiny. How much resources are you dedicating to failing banks? The second one is about auditing. How do supervisors shape financial statements? The third one is enforcement actions. And then the fourth one is just going to be bank closures. Okay? With respect to scrutiny, here's just one simple way of illustrating this. This is just going to plot you the distribution of the days elapsed between 2 consecutive on-site examinations for banks that are on the rotating schedule. So those banks are sort of in good standing, have a Camel's rating of 1 or 2, fulfill a bunch of other conditions. Now, if you're on the rotating schedule, you either have an exam every 12 months or every 18 months. The data just back that up. Once in a while, there'll be a bank that has an exam, more frequently. That's because of mergers and a bunch of other stuff. Now let's look at only failing banks. Well, if you have a failing bank with using sort of the benefit of hindsight, 5 years before it fails, you see this distribution shifts to the left, and examinations tend to happen at a much higher frequency. In fact, in the year before failure, the average time elapsed between 2 exams is just going to be 150 days. So it's basically the supervisor just finished an exam, is just about to turn out and come back to the bank for another exam. Okay? So the paper we show much more, although these exams are also going to be longer. That's going to be more often led by federal examiners. Now, with respect to auditing, I'm going to now argue to you that if you think about the call report and the financial data that banks publish, that's really an actual piece of financial information that's really shaped by supervisors. So how am I going to make that point? Well, I'm just going to plot you here the probability of a historical revision of either net income or equity in a call report around bank on-site examinations. So what that's just telling you, in the month around a bank examination, in the run up to the examination, the probability of the bank revising its historical call report submission is relatively low, but it jumps up once an exam has concluded. Okay, so that's sort of indicating that supervisors are having a substantial effect on what is actually written in the financial statement. Now, this kind of graph could be subject to the criticism that a banker is just going to understand very well that they're going to have to revise their historical call report, and they're just going to do it when the exam happens and all kinds of paperwork happens. One way to address that is, well, let's just look at exams led by state bank regulators and by federal agencies. Now, it's well established that given the exact same financial information, state bank examiners are just going to be a little bit more lenient than federal examiners. That's just due to the different incentive structures that we're facing in the dual banking system. Now that's going to tell you sort of something causal about what supervisors are doing. In the run-up to the exam, there's no difference between the state and the federal supervisor, but right after the exam exam led by a federal supervisor is going to have a much higher propensity of a revision of the originally submitted call report. Now, you may wonder, well, what about these revisions? Are they actually material? So one way to look at this is let's just plot again in the 5 years before a bank fails, the equity to assets ratio in the original first submitted call report, and then in the final call report as of 2024. Okay, what you see is the original submission of the equity to assets ratio always is slightly above what is the finalized equity to assets ratio in those failing banks. Now what I can do is I can accumulate these revision errors over time, over the 5 years before failure. If you do that, it gives you these green dots. So what that's just telling you is that in the 5 years before failure, the equity to assets ratio is going to decline by something like 8%, 8 to 9%. But basically half of that decline comes from revisions of the original call report. So if you wanted to make the most extreme, let's say you can causally attribute all call report revisions to supervisory actions, which is definitely problematic, but it's an upper bound. It's going to tell you that supervisors are really what pushes banks to look undercapitalized before they fail. Now, capitalization is important because it triggers enforcement action. Enforcement action doesn't happen randomly, but it's usually based on capitalization. So here I'm just showing you some simple descriptics. Banks that haven't failed over the last 25 years are much less likely to be subjected to enforcement actions. That's going to be enforcement actions only from federal agencies, so FDIC, OCC, and Federal Reserve. Now, you have about a 35% chance of having any type of enforcement actions if you're still in business right now and have existed over the last sometime over the last 25 years. 80% of banks that ended up failing over that time period had some type of enforcement action. And there's really big differences when you think about the most sort of drastic types of enforcement actions, such as PCA, that almost never happens in a bank that doesn't end up failing. And in 25% of all the banks that ended up failing over that time period, it happened. Various reasons why it's not more banks that are subject to PCA. Happy to discuss that later. Now, my final point on sort of giving you some simple descriptive statistics is just to plot you the distributions of the days of failures of banks for both historical national banks, so that's national banks that failed sometime between the Civil War and the Great Depression, and then banks that failed since 1992 in the United States. So the blue dots are just showing you that in the historical US banking system, banks essentially failed on any random day. They didn't fail on Sundays, well, because they were closed. They're a little less likely to fail on a Saturday. That's in part because Saturday is just half a business day and people are going to take a bath or going to the pub or something. But they really just kind of randomly failed throughout the day. That's because historically when banks failed, that was a decision made by depositors voting with their feet that they were not happy with the bank anymore, or the owners themselves trying to protect their whatever remain of their equity in closing the bank. Very different in the contemporary banking system, where it's really a supervisory decision when a bank is closed. As you all are well aware of, typically the FDIC prefers to close a bank at the end of business on a Friday, will rewire the IT system and open that failed bank as a branch of the acquiring bank on the next Monday. But it's really making the point that supervisors are hardly ever sort of overwhelmed, at least in an immediate sense, by market forces, but they are actually the ones who decide which banks will fail and which ones will not. That doesn't mean failures are not costly. In the paper we discuss this, and you may all be well aware of, there can be substantial costs for the deposit insurance fund. Now, everything I've said so far is purely descriptive. What we're really interested in is sort of trying to say something causal. So that if you came to me and asked, what if I made supervision more lenient or I made it more strict, what would happen? Now, how we go about answering that? Well, the identification challenging of any observational data is that supervisory strictness and sort of bank conditions are endogenous. So supervisors are sort of drawn to the more troubled banks. So what I'm going to do is I'm going to essentially again exploit this difference between state and federal examiners. The fact that state examiners are a little more lenient, same financial information, they're going to be more lenient. And then I'm going to exploit the rotating schedule at the onset of the financial crisis. And the basic idea is that right before Lehman fails, there's some banks that are scheduled to have a federal-led exam, and some are scheduled to have a state-led exam. And if that's arguably random, so that's some arguably random variation that's got nothing to do with what's going on in the financial crisis, because all those banks have a good Camels rating, they're in good standing. But it's relevant in the sense that if you're getting a federal exam early on, you're more likely at the same financial information getting rated with a 3 or 4 or 5. So you're more likely to end up on a list of troubled banks, which is then going to trigger automatically additional supervisory scrutiny. And what then helps is that during the GFC, the supervisors essentially became overwhelmed. They become resource constrained, which meant that essentially they couldn't go out and look for new problems, but focused on the banks already in trouble. So the idea here is essentially if you have 3 fires in a city and you have 3 fire engines, well, you're going to send those engines to those 3 fires. You're not going to look for new problems. Just showing you how this works. Now, essentially, this graph is just plotting you the average Camels rating for both banks that have a federal-led exam in the phase right after Lehman, and those that have a state-led exam in the phase right after Lehman, these 2 vertical lines. What you see is if you had a federal exam early on, your Camels rating is going to increase very, very fast on average, and then essentially remain much above the orange line for most of the GFC. You also see that after about 1.5 years, the banks that had a state-led exam right after the failure of Lehman Brothers, they catch up, but they don't catch up all the way, which comes from this sort of path dependence that I was talking about. Now, in the paper we discussed this in much more detail, but essentially this is going to set the stage for 2 main results. The first result is that if you have more supervisory strictness in an exogenous sense, you're going to be more likely to fail. So stricter supervisors, because bank failures are supervisory decisions, are going to close more banks. So in my sample, the probability of a bank failing is 3.5%. The difference between a bank that gets more supervisory scrutiny and that gets less is 3.2%. So that's massive. It just emphasizes how important supervisors are. What you're getting sort of, if you're getting a stricter supervisor, you're going to get lower losses for the deposit insurance fund. So on average, the FDIC loses 22 cents on the dollar in a failure. It's going to be a 9-cent difference if you had a stricter supervisor. And this for various reasons. One is essentially that stricter supervisors just close banks much faster, so there's sort of less potential for things to go bad. But, and here's a big but, it comes at a cost. This does not come for free. You also find that if you have stricter supervisors, in the immediate phase after the crisis, you have much lower credit growth. So in some sense, you want to think of stricter supervisors as marking everything to market, tightening capital constraint, cleaning up the mess immediately. But that's not necessarily desirable because you're really going to see a big reduction in credit right away. So I'm out of time, but what I want to emphasize that there's this policy trade-off. So I'm just going to conclude a key role of banking supervision that you shall not forget if you're thinking about reform of the supervisory landscape is to avoid kicking the can down the road. And then there's this trade-off that you have. Stricter supervision is at the margin going to close more banks. You're going to have less losses from those failures, but you also potentially are going to have less credit available right at the height of a crisis when it's potentially very valuable. There's no welfare statements that I can be making here. It's more sort of, I'm telling you as a policymaker, if you're a policymaker, this is a choice you have, and you want to carefully think about these trade-offs. Sorry for going over time.
No worries. Thank you, Stephan.